Hello students. So we have already covered with the major points by now. One is amalgamation in the nature of merger and purchase. Next is how to find the purchase consideration by three main methods: lump sum method, net payment method and net asset method. Now today we begin with the accounting entries. First we study accounting entries in the books of Transferor company. Transferor means the company which goes into liquidation, because practically first the company goes into liquidation, then acquired by a new company. So first entries will have to be passed in which company? The one which is going into liquidation. Then we will have to pass the entries in the books of which company? Which is acquiring it, transferee company. Today's lecture is entirely dedicated to the accounting entries in the books of Transferor company. Now, entries are very simple. Order of entries is very important to be remembered. So all of you understand one concept that you need not write, you just understand it. What is the format of balance sheet of company final accounts? Very first we write shareholders funds. Then we write non-current liabilities. In shareholders funds we include share capital and reserves. In share capital we include equity and preference. Then non-current liabilities, current liabilities. In assets we write non-current assets and current assets. Shortcut to remember the entries. There are many entries. 13-14 entries are to be passed. So try to remember this. First six entries what we pass in the books of Transferor company is to close the accounts appearing in the balance sheet. We have to close all these accounts appearing in the balance sheet because the company is going into liquidation. Company is winding up the business. So balance sheet should become zero. The company does not exist now. It has gone into liquidation. How would you make the balance sheet zero? How would you scrap the balance sheet? By closing all the accounts in the balance sheet, and therefore first six entries in the books of Transferor company are derived from this closing entries only. First, let us decide which things will be closed and transferred where. Equity share capital will be closed and transferred to equity shareholders account. Preference share will be closed and transferred to preference shareholders account. Reserves belongs to equity shareholders. They don't belong to preference shareholders. Who are the main owners of the company? Equity shareholders. So reserves and surplus belong to equity shareholders. Reserves and surplus will be closed and transferred to equity shareholders account. Okay. Non-current liability will be closed and transferred to realization account. We open an account to record the sale of assets and payment of liabilities, which is called realization account. You studied this account in first year BCom and 12th standard also when we had dissolution of partnership firm. This is dissolution of company. So account remains same. Whichever business goes into dissolution, the account remains same. Because you are going to sell the assets, so money is going to be realized from sale of assets, which will be used in paying your liabilities. Hence, the account prepared for realization of assets and payment of liabilities is called realization account. Current liabilities are all third party liabilities, so again it will be closed and transferred to realization account. Non-current assets will be transferred to realization account, and current assets will be transferred to realization account. The only point to be remembered is, except this non-current liabilities, current liabilities, non-current assets and current assets, shareholders funds will be transferred to shareholders account. But which shareholders? equity share capital and reserves and surplus to equity shareholders, and preference share capital to preference shareholders. What is the order of entries to be passed? First entry to close assets, second entry to close liabilities, third entry to close equity share capital, fourth entry to close preference share capital, fifth entry to close reserves and surplus. So I'm sorry, not six, but first 5 entries we will derive by closing these accounts. So first 5 entries will be to close the accounts appearing in the balance sheet, because the company going to liquidation. Since the company is going into liquidation, first we have to close all the accounts appearing in the balance sheet. So once again, order of entries is important. Entries are very simple. Remember the order: assets, liabilities, equity share capital, preference share capital, reserves and surplus. One more entry will come, as I said, 6 entries, but that will be a part of reserves and surplus only. Fictitious assets means if reserves and surplus has a profit and loss accounts debit balance, then in that situation the sixth entry would come. So I was correct, 6 entries would only be there, but the sixth entry would be for fictitious assets. Okay, so once again, order of 6 entries: assets, liabilities, equity share capital, preference share capital, reserves and surplus, fictitious assets. Once again, assets, liabilities, equity share capital, preference share capital, reserves and surplus, fictitious assets. Last time: assets, liabilities, equity share capital, reserves and surplus, preference share capital, fictitious assets. You remember this order of 6 entries. Entries are very simple. So 6 entries, half the battle is done. Half the battle you have won. Out of 13, 14 entries, almost 6 entries are just to close the accounts. Now what are these entries? First, to close assets. Entries are very simple to understand. They are basic accounting rules only. Now see, assets have debit balance. So to close it, you will reverse and credit. And where do we transfer all the assets? Realization account. So realization account debit. All of you must be writing this when you are watching the lecture. To assets account. Okay, I repeat, assets have debit balance. To close it, we reverse and credit, and realization account debit. So realization account debit to assets account. Second. Okay, after assets, what did I say? Remember the order: assets, liabilities. So second entry is to close the liabilities. Now liabilities have credit balance. So to close it, we will reverse and debit it. Liabilities account debit, and we transfer it to realization account. So to realization account. Okay. Now one difference is there. In assets, we have to close all assets, whether taken over or not. Means new company, transferee company, whether the new company takes over the asset or not. All assets will be closed and transferred to realization account, whether taken over or not. However, in case of liabilities, only those liabilities will be closed which are taken over. Only those liabilities will be closed which are taken over. If any liability is not taken over, we don't have to close it. The company themselves have to settle that liability. So if any liability is not taken over by the transferee company, it will not get closed. That liability will still stand as liability in the balance sheet of old company until transferor company itself settles it. So in case of assets, all assets will be closed and transferred to realization account, whether taken over or not. But in case of liabilities, only taken over liabilities by the transferring company will be closed and transferred to realization account. Now, what is the order of entries? I said assets, liabilities, equity share capital. So to close equity share capital, now equity share capital also has a credit balance. Okay, capital always has a credit balance. So to close it, we reverse and debit it. Means equity share capital account debit. Okay, equity share capital has a credit balance. So to close it, we reverse and debit it. Equity share capital account debit. And we transfer it to equity shareholders account. So you'll transfer it and credit it to which account? Equity shareholders account. As I discussed, equity share capital, equity shareholders, reserves also equity shareholders, preference share capital, preference shareholders. And along with reserves, fictitious assets, equity shareholders will have to bear the loss. So exactly like equity share capital, the entry is for preference share capital. To close preference share capital, preference share capital also has a credit balance. So to close it, we will reverse and debit it. Preference share capital account debit. And we transfer it to preference shareholders account. So to preference shareholders account. Okay. So entries are very simple, basic fundas of accounting. Close it, reverse it, and opposite account if you transfer to realization account. Opposite account if you transfer to equity shareholders account. If you transfer to preference shareholders, then preference shareholders account. Next, to close reserves. Now reserves always have credit balance. So to close them, reserves is a credit balance. To close it, we will reverse and debit it. So reserves account debit. And who has a claim on the reserves of the company? Equity shareholders. So to equity shareholders account. Okay, the claim on the reserves of the company belongs to equity shareholders. So to equity shareholders account. And last is to close fictitious asset, means particularly profit and loss account debit balance. If there is an accumulated loss in past, that is called fictitious asset. It will come under reserves and surplus only. Okay, it will come under reserves and surplus only, but as a negative amount. So in reserves and surplus, if profit and loss is a negative amount, means it's a debit balance, accumulated loss. To close this debit balance, we will reverse and credit. And who will bear this loss? Owners, main owners, equity shareholders. So equity shareholders account debit to profit and loss account. So first 6 entries will result in closure of all the accounts appearing in the balance sheet. Let's revise it once again. You remember the order of entries. Entries are very simple. What is the order of entries? Assets, liabilities, equity share capital, preference share capital, reserves, and fictitious asset, that is profit and loss, accumulated loss, debit balance. Assets, liabilities closed and transferred to realization account. Equity share capital, reserves and surplus, and fictitious assets closed and transferred to equity shareholders account. Preference share capital closed and transferred to preference shareholders account. So assets have debit balance. To close it, we reverse and credit to assets account, and what we debit? Realization. Liabilities have credit balance. To close it, we reverse and debit liabilities, and what do we credit? Realization account. Equity share capital has credit balance. To close it, we reverse and debit, and what do we credit? Equity shareholders account. Preference share capital as credit balance. To close it, we reverse and debit. And what do we credit? Preference shareholders account. Reserves as credit balance. To close it, we reverse and debit. And what do we credit? To equity shareholders account. They have the claim on the reserves. Profit and loss account as debit balance. To close it, we reverse and credit. And what do we debit? Equity shareholders account. They have to bear the loss of the company. Assets, all will be included whether taken over or not. Liabilities, only those liabilities which are taken over. And first 6 entries you can write as a note will be recorded at book values. Okay, don't consider the agreed values given in adjustment. First 6 entries will be recorded at book values. Why? Because what are we doing in these 6 entries? Closing the accounts appearing in the books of accounts. Closing of accounts has to be done with the values appearing in the books, that is book values. Okay, so if in balance sheet the value of machinery is 10 lakhs, agreed value taken by the new company is 8 lakhs, we will not close it with 8 lakhs, we have to close it with 10 lakhs only, which is appearing in the books of accounts. So first 6 entries you have to record with book values. Once we solve the practical questions, I'll explain you more about that. Now understand the remaining stream of entries. Next 2 entries you remember are for purchase consideration, because majority of assets and liabilities of transferor company are going to be taken by transferee company only, against which we are going to get purchase consideration. So 7th and 8th entry are for purchase consideration. 7th is for purchase consideration due. 7th is for purchase consideration due. Now, the purchase consideration is receivable from transferee company. Debit the receivable. So, transferee company account debit. I repeat, purchase consideration is receivable from transferee company. Debit the receivable. So, transferee company account debit. And it is our income, gain. Credit all incomes and gains. So to realization account. You'll directly credit that amount to realization account. It is a gain for transferor company. So you'll credit it to realization account. Now next is for purchase consideration received. Okay, purchase consideration received. Now how would this amount of purchase consideration be paid by transferee company? Majorly in the form of equity shares. Preference shareholders can be given preference shares also, and cash. Generally these are the 3 modes of settlement. Whatever workings we have seen so far of purchase consideration, net payment, net asset method, there also you have seen either the amount is paid in the form of equity shares or preference shares or cash. So if we receive it in the form of equity shares, then equity shares comes in, debit what comes in. So equity shares of transferee company account debit. Mind well, don't write share capital. I repeat, don't write share capital. Capital is always for the company which issues the shares. So it's a capital for transferee company which is giving the shares. Transferor company is receiving it. It's like an investment. Okay, they are receiving the shares. For them it is not share capital. It is simply equity shares of transferee company account debit. Same way, if preference shares are received, then preference shares comes in, debit what comes in, preference shares of transferee company account debit. If cash is received, then cash comes in, debit what comes in, or bank is the receiver, debit the receiver. Now don't write cash and bank of transferee company account debit. Cash and bank is cash and bank only. Whether it is of transferee company or transferor or XYZ company, it is simply cash and bank. So cash and bank account debit. 2. Transferee company is the giver, credit the giver. So to transferee company account. So this account which was debited as a receivable, once you receive the purchase consideration, it gets credited and closed. I repeat it. After first 6 entries, closing entries, what are the next 2 entries you'll remember? Purchase consideration. 7th is purchase consideration due. 8th is purchase consideration received. For purchase consideration due, purchase consideration is receivable, debit the receivable, so transferee company account debit. And it is an income for the transferor company. Credit all incomes and gains to realization account. Same way for purchase consideration received. How do you receive the purchase consideration? Mainly there are 3 modes of payment. Either you will receive it in the form of equity shares or preference shares or cash or combination of any of these 3. So equity shares comes in, debit what comes in, equity shares account debit. Preference shares comes in, debit what comes in, preference shares of transferee company account debit. Cash comes in, debit what comes in, cash or bank account debit. Transferee company is the giver, credit the giver to transferee company account. Okay, so 2 entries of purchase consideration. Next. Now, if any asset is not taken over by transferee company, then the liquidating company will have to sell, the transferor company will have to sell the assets on their own. So what is the 9th entry to be passed? For sale of assets not taken over. Those assets which are not taken over by the transferee company will have to be sold by the transferor company itself. So for sale of assets not taken over, cash comes in, debit what comes in, you're selling the assets. So cash or bank account debit. Now asset goes out, credit what goes out to asset account? No, wrong. We cannot credit assets account because all assets are already closed and credited here, whether taken over or not. Since all assets are already closed and credited over here and transferred to realization account, we have to now credit to realization account. And any profit or loss is not to be recorded, it automatically gets recorded. Why? Because assets account you close with book value, suppose machinery of 10 lakhs. So assets account you credit here machinery with 10 lakhs and transfer it to realization account, means in realization account, realization to assets, so debit side machinery will come with 10 lakhs. Now suppose you sell it for 8 lakhs. So cash and bank to realization. To realization means in realization you'll credit the amount with rupees 8 lakhs. So automatically this difference of 2 lakhs remaining in the debit side represents the loss of the company. We don't have to record it separately. It automatically represents the loss of the company. Okay. So what important thing you have to remember regarding closing of assets, sale of assets. Very first, you cannot credit assets account because assets account all are already closed and transferred to realization account. So after the first entry in the ledger book of the company, there is no account of asset. They all are closed. Okay, all were transferred whether taken over or not. So instead of assets, we have to credit now which account? Realization. Now in realization, assets are already transferred at book value. Selling price is also recorded. So difference automatically gets recorded as profit or loss. We don't have to record any profit or loss. Okay. So here you remember no entry is to be passed for profit or loss on sale of assets. It automatically gets recorded. Next, same way those liabilities which are not taken over will have to be paid by the company. So for payment of liabilities not taken over. Okay, those liabilities which are not taken over will have to be paid by the transferor company itself. So for payment of liabilities not taken over. Now here there is a difference. Assets all we closed and transferred to realization account whether taken over or not. But in liabilities only the liabilities taken over were transferred to realization. Means those liabilities which are not taken over are still existing in the books of transferor company. So now when we pay that liabilities, those liabilities are the receiver, debit the receiver, liabilities account debit. And for making the payment, cash goes out, credit what goes out to cash or bank account. And here the difference amount will have to be transferred to realization account as profit or loss. Because if liability in the books is 5 lakhs, you settle and pay at 4 lakhs, then 1 lakh is your profit which you have to transfer to realization account. It does not go automatically like assets. Why it does not go automatically like assets? Because in assets, all assets were closed and transferred to realization whether taken over or not. So there the profit or loss automatically gets recorded. But liabilities which were not taken over are not transferred only to realization account. So now its profit or loss we have to transfer to realization account. Okay, you all understand this difference again? Assets were all closed and transferred to realization whether taken over or not. So we cannot say assets goes out, credit what goes out to assets account because assets are already closed. So we credit realization account. But liabilities only those were closed and transferred to realization account which are taken over. So those liabilities which are not taken over still exist in the books. Therefore here we cannot debit realization account. Here we will debit liabilities account only to close them. To cash or bank account, and difference amount what is your profit or loss will be transferred to realization account. Here no entry for profit or loss, but here profit or loss will be separately recorded in realization account. In assets it automatically gets recorded. So keep it in mind. Sale of assets, cash or bank to realization, not assets, because assets are already closed. But payment of liabilities, liabilities to cash or bank. Liabilities because liabilities still are not closed, they exist in the books of accounts. So after 6 entries, let us recollect the order again. 7 and 8 for purchase consideration, due and receipt. 9 for sale of assets. 10 for payment of liabilities. 11 for payment of liquidation expenses. The company is going into liquidation. So liquidation expenses will be involved. The expenses of selling the assets, payment of liabilities, some expenses will be involved, giving advertisement in newspapers, etc. So liquidation expenses, debit all expenses and losses, directly realization account debit. Okay, because we have already opened an account for that. Cash goes out, credit what goes out to cash or bank account. Okay. So liquidation expenses, debit all expenses and losses, realization account debit, cash goes out, credit what goes out to cash or bank account. Then for payment to preference shareholders. For payment to preference shareholders. Generally, preference shareholders would be given preference shares only in the new company. So, preference shareholders are the receiver, debit the receiver, preference shareholders account debit. I repeat, preference shareholders are the receiver, debit the receiver, preference shareholders account debit, and what will they be given? These preference shares, okay, which we received of transferring company. So this preference shares, if we give them, then preference shares goes out, credit what goes out to preference shares of transferring company account. Okay, preference shares goes out, credit what goes out to preference shares of transferring company account, and here also any difference amount will be transferred to realization account, because if you give them more value of preference shares, then finally equity shareholders have to bear that loss through realization account. If you give them less value of preference shares, then finally that gain will go to equity shareholders through realization account. So you remember that in this 12th entry, if preference shareholders is different amount and preference shares what we are giving them of transferring company is a different amount, then the difference between the two amounts, whether debit or credit, will be transferred to realization account. Lastly, we have to close. All accounts get closed. Preference shareholders also which were debited here, get closed by, preference shareholders which were credited here, get closed by debiting them here. Okay. Now we have to close realization account. Now here actually journal entry is not important, because when we prepare the ledger accounts, then through ledger account you can derive the entry easily. However, to understand the concept, two things are possible when you close realization account. Either you can have profit in that or loss. If you have profit, then realization will have credit balance. I repeat, if you have profit, then realization account will have credit balance. To close it, you will reverse and debit realization account. And who will get this profit? Equity shareholders account. But this entry automatically we will get when we prepare the ledger account. So even if you don't remember, it's fine. 12 entries are basically to be remembered. Alternatively, if there is a loss, then realization account will have debit balance. To close it, we will reverse and credit, and equity shareholders will finally bear that loss. So equity shareholders account debit, and realization account with a debit balance of loss will be closed and credited to realization account. So either you will have profit or you will have loss. One of these two entries will come, but however, don't worry, even if you don't remember these two entries, it's okay. Remember 12 entries only. 13 and 14 is just the steps. Realization account, you just whatever and wherever the balance remains, you remember realization account is closed and transferred to equity shareholders account. And lastly, the main owners of the company, equity shareholders settlement. Okay, finally we have to settle the equity shareholders. All others are settled now. So equity shareholders settlement. Now equity shareholders settlement means what are we going to give them? We will be giving them this equity shares what we received from the new company, and this cash what we received from the new company, plus if any surplus cash is remaining in the company, that also will go to equity shareholders. So equity shareholders are the receiver, debit the receiver, equity shareholders account debit. We will give them the equity shares. So equity shares goes out, credit what goes out to equity shares of transferee company account. And if you give them cash, then cash goes out, credit what goes out to cash or bank account. Again, this 14th entry also you need not remember. You just remember 13 and 14 as steps. You just remember 13 and 14 as steps. What steps? In 13th entry, close realization account. And where do you transfer it? Equity shareholders account. 14th entry, close all other accounts. And where do you transfer? Equity shareholders account. And equity shareholders account must get closed and balanced, tallied. If equity shareholders finally gets tallied and closed and balanced, means all your entries are right. So instead of remembering 13 and 14 entries, you just remember two steps in 13 and 14. 13th step, close realization account and transfer to equity shareholders account. 14th step, close all other remaining ledger accounts and transfer it to equity shareholders account. Equity shareholders must get balanced, tallied. Okay, so total 14 entries in all to be passed. Let us revise them once again in brief. First 6 entries, closing. Just remember the order. Entries you can derive on your own very easily. It's a normal accounting concept. Order only is important. First, close assets. Second, liabilities. Third, equity share capital. Fourth, preference share capital. Fifth, reserves. Sixth, accumulated loss. Then, 7th and 8th entry are for purchase consideration. Okay. 9 is for selling the assets. 10 is for payment of liabilities. In selling of assets and payment of liabilities, remember the concept. Assets all were closed and transferred to realization. So here also realization will come. Liabilities all were not closed. So here liabilities will only come. 11 liquidation expense. 12 payment to preference shareholders. And then 13 close realization and transfer to equity shareholders account. 14th close all other accounts and transfer to equity shareholders account. After watching this lecture, Without seeing, all of you must write all the 14 entries again. I repeat, all of you must write all the 14 entries again. Even if you write first 12 entries, and 13 and 14 as steps is more than sufficient. 13 and 14, even if you write just these two steps, it's okay. But first 12 entries you all have to remember. Okay? So revise these entries properly, because in all the long questions it's going to come, and if you don't remember these entries, it will be very difficult for you to solve the long questions. Okay? Bye everyone. Take care. Learn these entries by heart. Next lecture we'll see the entries in the books of Transferor company. Bye.